It's common knowledge now. The average 30-year mortgage rate in the US has hit an astonishing 7.6%, a peak not seen since December 1st, 2000. This dramatic surge has turned a growing concern into a full-blown crisis. The stability of the market is now in question, as what began as a minor inconvenience has escalated into one of the most significant asset bubbles in financial history. The journey to this point is not just a story of the past, but a harbinger of a precarious economic future. The looming housing crash threatens to be the most severe we've ever faced. To understand why, we need to delve into historical data, examining clear signs that the current market conditions are highly unusual. People often refer to housing price charts, but these usually miss a critical factor: inflation. For instance, a house bought in 2000 for $200,000 would be equivalent to around $356,000 today in 2023. Thus, apparent gains may be illusionary. Adjusting for inflation reveals the true extent of the surge in home prices. The inflation-adjusted Case-Shiller Index, developed by Robert J. Shiller and Carl E. Case, provides a more accurate picture, showing that current prices have even surpassed the infamous 2008 bubble. Historical data going back to 1889 indicates that while there has been a trend of increasing real prices over the last century, the current situation is exceptionally dire, far exceeding the bounds of normalcy since 2012. This raises the question: how likely is it that we will revert to more traditional market conditions? At a certain juncture in this debate, the argument for a market crash becomes almost irrefutable, particularly when viewed through the lens of history. The emergence of the 2008 bubble following the year 2000 was not entirely unexpected, given the historical context of interest rates. Traditionally, these rates were high by today's standards, but the past 30 years have seen a gradual decline, setting the stage for the 2008 crisis. However, the real lesson wasn't learned then. Post-2008, the Federal Reserve continued to drive down interest rates, even hitting 2.6% at one point, inadvertently sowing the seeds for another bubble. From late 2011 to the present, the inflation-adjusted price of homes has soared by 66%, an unprecedented rate of increase, excluding the 2008 spike. Historically, such surges have always been followed by a market crash to realign with the average. Now, if this alone doesn't convince you, there's more compelling evidence that I believe is the definitive proof that the market is on the brink of adjustment. But before I delve into that, please consider supporting the channel by liking and subscribing. It's a huge boost and greatly appreciated. Returning to the analysis, while the housing market is significantly influenced by interest rates, it's important to note that most purchases are financed, often through 30-year fixed mortgages. These mortgages are closely tied to the 10-year Treasury rates, which essentially determines mortgage rates. The crucial question then is, how do these factors impact the value of your home? To unravel the connection between your home's value and current economic trends, we need to grasp some key concepts. Consider the 10-year Treasury note as a unique tool through which the government borrows money. In exchange for your cash, they promise a return with interest after a decade. Presently, the interest rate for this is around 4.5%. Here's where it gets intriguing. The 2-year Treasury note offers a higher interest rate of 5.02%. This inversion, a higher rate for shorter borrowing, defies the usual expectation of longer terms yielding higher rates. Such an inversion leads to what's known as an inverted yield curve, a classic recession indicator. Historical data since the late 1970s shows that every time this curve dips below zero, a recession follows. This pattern held true in the early 80s, 90s, 2000s, and notably in 2008 and 2020. The current trend shows a deeper inversion, suggesting we're not out of the woods yet. In fact, post-inversion periods often mark the real onset of economic downturns. This brings us to the crux of the matter regarding a potential housing crash. The near parity between the yield of 30-year and 10-year treasuries indicates investors' concern about future inflation. Typically, the 30-year yield should be more attractive, but current uncertainties make the 10-year option equally appealing. This suggests a collective belief in persistent high inflation. The Federal Reserve's rate hikes, meant to control inflation, are being met with skepticism by the bond market. If investors' sentiment is correct and inflation remains high, it could precipitate a crisis, especially in the housing market. We're venturing into uncharted territory where a potential breakdown could collapse the entire structure that has been building since 2012. This looming crisis could dwarf previous market bubbles. For homeowners, this scenario means grappling with higher mortgage rates payments, especially for those with adjustable rate mortgages or those planning to refinance. This could lead to an increase in foreclosures and a flood of homes entering the market at low prices. Real estate investors who banked on continuous appreciation in property values might find themselves with devalued assets and reduced rental incomes. As we near the conclusion of this analysis, it's crucial to not only understand the impending housing market crash, but also to know how to navigate these turbulent times. If you're a homeowner or investor, here are some actionable steps to consider. 1. Evaluate your mortgage. Homeowners with adjustable rate mortgages should assess their situation. If your rate is set to increase, it might be wise to refinance to a fixed rate mortgage now before rates climb higher. 2. Build an emergency fund. Strengthen your financial safety net. Have savings to cover at least 6 months of expenses can provide a buffer against potential job loss or decreased rental income. 3. Consider selling high-value properties. If you own property that has significantly appreciated in value, selling now could lock in profits before the market potentially dips. 4. Diversify investments. Investors should diversify their portfolios to mitigate risks. Don't rely solely on real estate. Consider other assets like stocks, bonds, or even alternative investments. 5. Prepare for buying opportunities. For those looking to enter the market, the potential downturn could present buying opportunities. Keep your finances in order so you can act when prices drop. 6. Stay informed. Continuously monitor market trends and economic indicators. Being informed will help you make timely decisions. 7. Consult with professionals. Seek advice from financial advisors, real estate experts, or mortgage brokers. Professional guidance can be invaluable when making the right decisions. 8. Be cautious with new investments. If you're planning to invest in real estate now, be extra cautious. Analyze the local market thoroughly and avoid over-leveraging yourself. 9. Plan for long-term holding. If you already own investment properties, prepare for the possibility of holding them longer than anticipated. The market may take time to recover, so ensure your finances can withstand this. 10. Educate yourself. Use this time to educate yourself more about real estate and financial management. Knowledge is a powerful tool in uncertain times. Remember, the key to navigating any market is preparedness and adaptability. By taking these steps, you can position yourself to weather the storm and possibly even emerge in a stronger position. Thanks for watching. If you found this information helpful, please support the channel by hitting the like and subscribe buttons. Your engagement helps us to continue to provide valuable content. Stay tuned for more insights and strategies in the world of real estate and finance.